Good evening, everyone. Welcome back to the channel. So I have a very exciting video for you all this evening, and this should be what will become what YouTube calls an evergreen video, which should be relevant for a long time. This is going to be the basics of a 401k, and what inspired me to talk about this topic this evening is so I recently started a new job about a month and a half ago now, and I had to set up my second 401k because I didn't roll over my first one from my old job. So I got to start from scratch again after, basically 10 years later. So what I want to go over today is basically how to set up from scratch. So starting a 401k can happen in a variety of situations. You could be right out of school, starting your first job. You could be changing jobs and setting up a new 401k. Or, I mean, whatever, you could be starting a 401k even later in life, even after you've never started one. And the first tip I would give, well, before I get into that, um, most of this video is going to be just me talking. So I know for those shorter attention spans, I may lose some of you, but try to stick with me. I'm at least, I'll try to make it fun at least. I mean, I got my, interesting hat and whatnot. But what I'm going to go over for the main part, I actually have the funds that I picked in my new 401k here, starting with this one, which we'll get into in just a second. So, and then what I'll do, I'll probably do a screen share later in the video to discuss, the market performance and how it can affect these funds. So, but a lot of exciting stuff is in store. So that's going to kind of be the structure of the video. So to start off with, what I would encourage everyone to do, since this video is going to be mostly just me talking or me coaching, uh, I would say the best thing for you to do to create long-term sustainable wealth is to max out your 401k. And I would strongly recommend that you do this regardless of your income. So if you make like median income, if you make 50,000 or under, maxing out your 401k is going to probably take half of your income, which for a lot of people that's, a tough pill to swallow. But doing that was going to pay off immensely in the long run. And what I'll do, I'll actually go over, a Google document, a spreadsheet that I have. And because I've talked about this in other videos before, I have other videos talking about the $1 million 401k. And what I want to do there is, I'll link to those videos also. Trying to make sure I'm on full screen here. I think I am. But anyway, so So yeah, you want to max that out, which the maximum that you can contribute to a 401k. So you could do a Roth 401k or you could do a traditional 401k, which for me, well, I do both a Roth IRA and a 401k, but what works for me doesn't necessarily work for everyone. So what I recommend, because this is like two-sided coin. If you do a traditional 401k, which is a tax deferred IRA, you're going to pay the tax. You pay the tax either way. With a Roth, you pay up front. With a traditional or deferred, you're going to pay down the road. But without paying the tax up front, you have more money going in that can grow. So the legal limit increases every year, and it's been increasing every year for the past many years. It was like $19,500. It's increased to 20,500, and the good news is it's increasing to 22,500 to accommodate for inflation. So that's really good. That means you can contribute even more to the 401k. So, in fact, let me do this here. I will share my screen because I know not all of you want to just watch me talking, as interesting as that is. Let me do share screen, and then I will pull up an article just so we kind of have a visual to go off of. Okay, so let me just do, let's see here. I guess I'll just do entire screen for now. Okay, so let's let's do this because we'll talk about this for. So yeah, 22,500 is what it's increasing to, and I highly recommend that each of you does this because the more you can max this out. I mean, just think in simple mathematical terms, okay? So 22,500, assuming no increase, 22,500, that's $225,000 over 10 years, factoring in no appreciation in the market. Of course, we know the market is going to change between now and 10 years, like it's done the last 10 years. In fact, just the S&P 500 alone has increased its average like 20% a year in compound annual growth. And of course, as we'll get into later, S&P 500 is always one key staple of the THB 401k. Every one of them that I have, like I said, this is my second one. Now, the reason I'm not rolling over is because I'll just go ahead and get into this now. So when I started this new job, every company has different 401k funds. They have their own funds, like I've talked about before. Index funds are kind of similar based on the company, whether you do Fidelity funds, Vanguard funds, JP Morgan funds, BlackRock, they're all kind of the same. But I typically, for my 401k, this is what I pick. This is the THB method, so to speak. So I always have an S&P 500 index fund. And I actually, it's funny, my company was nice enough to send me paper printouts of the prospectuses, or is it prospecti for plural, of the funds that I got into, that I picked. So I carefully hand selected these. I don't do the autopilot thing. Some people do that. It's like people that pick financial advisors. They don't want to think about money. See, me, I love thinking about money. And what I always tell everybody is that even if you don't like thinking about money, the way to get to the point where you don't have to think or worry about money is to get good at thinking about money. That's kind of the irony of it, right? So, and the thing is, too, if you don't want to think about money, in my opinion, you're more prone to getting screwed over because if you go to a financial advisor, which I don't have a very favorable opinion of, as you know, those of you that watch me regularly, and I used to work for them because most of them, and there are some good ones, and I'm not saying they don't provide some value, but they just rip you off. They put you in funds that pay them a commission, and they just rip you off. So whereas people like me exist, with this channel to empower you to take control of your own finances. Just watching me for free, I might make a little ad revenue on it, but this is free stuff, free coaching session. Just watch my ads, right? So what I do, like I said, I always pick an S&P 500 fund. The big one that I like is the large cap fund. But when I got to my new company, I freaked out. I said, no, they don't have a large cap fund. So what did I do? And how do you accommodate for something like that when you start a job at a new company and they don't actually have a large cap growth or index fund? And why am I so into that? Because at my last company, the large cap fund I was in, it was doing like 35% a year for 3 to 5 years in a row. It's phenomenal. I mean, if you had everything in that, you were probably doubling your 401k every year, which I'm going to show you. The more money you have in there, when you start doubling that and when you start getting 35% rates of return, it can produce more than what you make in a year. That's where that compound interest magic comes into play. So, and what I would recommend every one of you watching this, watch this as many times as you need to. Cut out all distractions. Put the phones down. Mute the TV. Just really focus on this. Take notes if you need to, because what I'm saying here is more valuable to you than whatever's on the phone or on the TV or whatever distraction that you have. And jumping back to what I said towards the beginning of the video, I highly recommend, no matter what kind of money you make, I highly recommend maxing out your 401k. So even if you make like 40 to 60,000 a year, this could take half of your income, which would take a significant sacrifice on your part. But hopefully, if you're starting out at those levels, hopefully you're actively trying to improve your income, which is step one. You got to constantly try to improve your income, which I did, of course, by finding a new job. That's what you got to do. You got to not do what I did and stay in the same company for too long, but you want a job churn That's one of the many churns that I talk about on this channel. You want a job churn every 3 to 5 years, not maybe not every 3 years, because that may look bad on a resume. If you change jobs every 3 years, it may raise a red flag. So maybe every 3 to 5 years, but you're going to hit a wall at every company that you're at. You're going to end up hitting a wall. So you want to, the only way to get a big raise a lot of times is to transfer or leave your current company, transfer to another company. You could even put the icing on the cake and get a severance from the company you're at, pocket that and then go to another company. These are all, good, ideas here. So, but the point I want to emphasize, to beat the game of life, or to, be better than average, because for me, and I try to advise or coach anyone that wants to listen to me. You want to be better than average in life, because what's happening, average, how can I say this? Being average is, it's been okay in the past, but more and more it's not going to get the job done. You've got 8 to 9% inflation every year, and the worse that people's outcomes are, it pulls the average down. If you understand the laws of, the mean and averages, the laws of averages, basically, the average is pulled down as outcomes worsen. So more and more, you need to be above average. And I'm going to tell you how to do just that. So step number one, key step, is to max out your 401k. Some of you may say, well, what does that have to do with being average? Just follow me here and connect the dots. You kind of got to think outside of the box a little bit, and I would say, take notes and observe. Sometimes the less questions you ask and the more listening you do, the better. So I can't emphasize enough, max out your 401k. Even if you make, like, say, 40 to 60,000 a year, and this will take significant sacrifice on your part. I don't care if you have to eat, ramen noodles for a year. If you have to go back to how you were, like, in college, you have to act like you're poor until you've made it. Because here's the thing, and you know what? Let all your friends laugh at you. Let them mock you, because down the road, in the long run, you'll be laughing all the way to the bank. Trust me. And those same people that laugh and mock you, if they're still your friends down the road, they'll be coming to you trying to hit you up for money. So watch that. Take note of that. But you can't, do, like I said, if you want to beat the game of life, you can't do what the average person, and what society pushes you to do. You know, you got to be different. It's okay to be different in this regard. So anyway, so max that out, sacrifice everything you need to, cut out, going out, things like that. Make as much money as you can, max that out, because you're going to be sitting very pretty at the end of 10 years. So that's step number one. Step number two, as I kind of started talking about, let's see what I got here. I think this is my spreadsheet here. Let's see. Okay, yeah, this is it. Let's see. I've got a lot of different stuff here. These are all other videos I've done here. Here's my favorite scenario here. This is why I'm so keen on maxing out your 401k, because, like I just said, if you do this every year for 10 years, you're going to be sitting very pretty. And it's not outside of the realm of possibility that you could have $1 million at the end of 10 years if you follow the THB method. And I mean, this isn't like proprietary. I didn't patent this or anything. What's worked for me, and it's worked for many people. Not everybody talks about it, but this has worked for many people. So at the end of 10 years, just assuming, and now what you'll notice here, if you follow with me, this very simple model doesn't factor in any further increases in the IRS limit that you can contribute to the 401k. So holding everything equal, $22,500 a year for 10 years. And then assuming the market gets back to very good returns. Now I'm assuming, like I said, with the large cap fund, that was doing 35% a year. Because you're probably wondering, well, how in the heck, this seems really crazy. How can I have $1 million at the end of 10 years? And yeah, I try to spice up the example a little bit, because I design it to, get your attention, so that, because if you think about $1 million, if you're aiming for that, it's going to, number one, make you more likely to pay attention. And number two, make you more likely to want to do it. So 225,000 in principle, but watch this here. If the return, if you follow my formulas here, 35%. So the sum of one, that's the whole value, whole amount. So that's 100%. So you add 0.35 to one, you get the return for year one, right? And then what you do for year two, you have this cell, you add cell B3, and then you add yeah, so this is B3. You're going to add the return from the year prior. And then say you do 25% in the next year. So then that's 25% on top of what you put in last year, what you put in this year, and what it grew to. So this is where compound interest starts to take shape. And this isn't even factoring in matching, company matching, which at a good company, you can get anywhere from, 5 to even 8%. Because what a lot of companies have done, they've eliminated their former pension plan and they've taken that percentage, say it could be 1 to 3%, some cases 5% if you stay at a company for a long time. They've taken that and they've rolled that into the 401k. So now you can get up to 8% at certain companies. So 8%, that's on top of whatever the market does for that year. But this simple example is not even factoring that in. So I'm just assuming 25% for the next couple of years, then 35%. Like I say, this may seem high, and forget that I didn't factor in matching because the higher rates of return could factor that in. Say the 8%, just subtract that. You get the idea. This is a very simple example, but you see how this works. At the end of 10 years, there's $1 million. So if you follow this, this is what could be possible in a certain sense. So going back here, just checking how we're doing on time here. Okay, so I started to say this here. My current 401k, because I look at this as icing on the cake. Say you work at anywhere from 3 to 5 companies in your lifetime, you could end up with 3 to 5 different 401ks. So if you work like a 50-year career, you could do what I'm showing here 5 different times in your life. So like I say, if you follow the right steps, time is the key variable. Time and rate of return, those are the key variables. If you follow the script here, because I know a lot of us, we need kind of a script handed to us in life so that we can follow it. Or, in some cases, make your own script. But if you want the script to follow, it's right here in front of you. It's just time and rate of return that are the two variables. So like I said, going back to this, what inspired me to do this, having to start a new 401k from scratch, right? So I'm actually in 6 different funds here, and I'm probably not going to show you all of them because, and you'll see why in just a second. Okay, so like I said, Russell 3000, why did I pick this one? Because, so this basically took the place of my large cap fund. So what I did, I meticulously went over every underlying investment that my large cap fund was in. And so I researched the closest fund to the large cap fund based on the stocks that they're in. So this one, the top holdings, Apple, Microsoft, Amazon, Alphabet, A shares, C shares, Tesla, Berkshire Hathaway, United Health Group, Johnson & Johnson, and Meta. So these are all pretty much the same funds that my former large cap fund was in. And it matched very closely, including historic rates of return and whatnot. So that's how I picked that. Another thing you look at here, if I can show you the prospectus here, I'll probably just, what I'll do a full screen in a bit once I'm done here. But I'll just go through. So obviously Russell 3000, and you think Russell, because Russell 2000 is typically the small cap index, but for this one, because I believe these are BlackRock funds, for this one, this matched very closely with the large cap. The other one I picked, a real estate securities fund. I put a small percentage in there. So I have about 6 funds, but the highest allocation is among 3 of them. The next one, because I went ahead and did a little bit of international diversification, emerging market equity fund. And another thing you want to look at is expense ratio, because these last 2 that I just told you have a very high expense ratio comparatively, compared to the first one, which is only 0.03. The second one is 0.52. The third one is 0.68. And then this may surprise some of my regular viewers, but I picked a bond fund, high yield bond, and that has a 0.49% expense ratio, but I picked that for this market we're in. The next one I can't show you because that's my company stock fund. And I was a little bit disappointed because, so my last company offered an employee stock separately from the 401k fund. This one only offers a 401k fund for the stock. So that is what it is. But anyway, when you job churn, you can always, and this is a trick too, in certain lines of work, you leave the company you were at for so many years and then work somewhere else for a couple of years, come back, skip a couple levels in the corporate rankings, and you kind of bypass the promotion wheel, so to speak, because promotions aren't always fair. That's another rabbit hole we could probably avoid on this channel. But I don't know, maybe I'll talk about that one day. But promotions kind of, there's a lot of politics involved. And if you're stuck in the same company for a while, you'll end up getting passed over for promotion. So the way around that is to job churn. So you get your promotion at your new company, and you probably get more of a raise than you would have gotten if you hung around and waited for your promotion. So if you're in like banking or finance or IT, the typical corporate rankings, you can be like an associate, you can be a VP, an SVP, and whatnot. So if you're looking to get your VP, you may be stuck at a wall at one company, and you go somewhere else, and then say you get the VP. But if you had gotten that at your former company, you may have only gotten like a 5 to 10% raise, whereas you can go somewhere else and get, who knows, 20 to 50% raise. And then if you get more education on top of it, the sky's the limit. Like if you get your master's degrees and whatnot, that can increase your compensation significantly too. Now, the last fund in the 401k, because this isn't about promotions and job churning, but that's just kind of a ancillary side note. The last one is the S&P 500 index fund. And this is really the bread and butter of any 401k. This one, how am I doing here? 5 minutes left in the day. See, I max out my day because like I go all the way till the end of the day and I end it with recording a video. So let me go ahead and go back to just me here. Let me end the screen share. So, okay, now you just see me again. So the S&P 500 index fund here, this is like the bread and butter of any 401k. Because the S&P, that's the 500 largest U.S. companies. So some people believe, that's like one of the ultimate ways to diversify and one of the simplest ways. And I would recommend this in any 401k, S&P 500, because you look at any of you that have an iPhone, you can just pull up the rates of return from the last 10 years. Of course, we had a record bull market, but if you go back to, just 10 years ago, you can do this very easily here on the iPhone. So you can do from the peak December 2021, December 27th, go back to November 2012. You'll see this here. You'll see 229% over that time frame, along with my reflection, 229%. So that's like 22.9% a year on average. So that's where that example came from that I showed you in the spreadsheet. That's why I'm so bullish on that one. But over the last 5 to 8 years, large cap, including a lot of these tech companies, was really record performance because of the performance of tech. So the jury is still out as far as if tech is going to ever get back to its glory days, so to speak, of the last 5 to 8 years. But that's why this fund, like this Russell 3000 that I showed, this was the best equivalent that I could find to the large cap fund that I had at my old company. And like I said, this one had Apple, Microsoft, Amazon, both shares of Alphabet, which is Google, Tesla, Berkshire Hathaway, United Healthcare Group. But those top 6, you keep those. Those were really the greats of the last 5 to 8 years. So, and then of course Meta. Now Meta could be one of the cheapest stocks. The PE keeps coming down. So, that could be primed for a big rebound. Because the thing is, like, if you study Zuckerberg, okay, Zuckerberg didn't get where he is, despite what you may think of him. There's a lot of stuff that's come out in the news about Meta, formerly Facebook. But Zuckerberg didn't get where he is by being an idiot. So he's eventually going to figure out this metaverse. Once he does, the stock could soar. So, okay, Russell 3000, and those are really the key ones. I've done some small caps in the past, but I would say, just as a general template of advice, S&P, large cap, your company's stock fund. Typically, I would stay away from bonds. I have a bond fund here. Emerging markets has done very well in certain years. I got into it like 5% here. And then I got into this real estate securities fund because this is in a lot of like, REIT funds like Simon Properties Group, Equinix, Prologis Holdings. Let's see here. Those are the key ones that it's in: Digital Realty, Mid America, Apartment Communities. So those, pay good dividends. And then, like I said, the bond fund. But that's really the top three large cap company stock and S&P. Those can do the best for you. And I will end on this here. I guess I'll throw in some bonus content, even though I kind of already hinted at it. I just want to look at Meta stock because I think this could be primed for a nice recovery in the next year or so. Okay, so you look at the PE ratio for Meta, 10.77. It was as low as 9, and I actually have a leap option on it because I'm still bullish on it over the long term. Some people may think that's stupid, but I still. It's a company I would wager on. Like I said, Zuckerberg didn't get where he is by being an idiot. So as of October 31st, it had dropped all the way to 90. So it's on a little bit of a recovery. So let's see, what else can I cover here? I beat up the 401k topic pretty good. 1 year target estimate on Meta is $153. So you can see right there, based on the analysts' estimates, that's a significant upside for the stock. 153 compared to where it is today. Let's see. That's potentially a 37% upside. It doesn't pay a dividend yet. Let's see when the earnings are next. Earnings come out January 31st. And eventually they should, because the ad revenue has been struggling, but projections are a little higher than the last quarter where they missed. They've missed the last 2 quarters. They only beat 1 quarter out of the last 4. So, but like I said, I'm still bullish on that one. Any 401k fund that's a part of could be a good one. We could be primed for a decent recovery once the Fed rates stop, or once the Fed rate increases stop. So those are all things to look out for. But anyway, I hope this was valuable. If you like that, please remember to like, comment, and subscribe. And I won't have a video out again probably tomorrow. I'll probably have one out Friday. So in the meantime, have a happy Thanksgiving. And I have a fully edited video coming out most likely Friday. So stay tuned for that. Thanks so much for watching. Take care.